7, 8, 10 years out. There's a relationship.
So everything is overpriced.
Yeah, and that doesn't help anything. The market since World War II has sold between 10 times earnings and 20 times earnings. If you look at the Dow Jones or the S&P 500, if you add up all the companies and take the earnings, you say there's a relationship. And it follows. McDonald's earnings have been terrific the last 30 years, and the stock's been terrific. There's a direct relationship. So the earnings of the S&P 500 have been between this range of 10 and 20. We were just about to go over the 20, which is the high end of the PE range. There wasn't a lot of room left on the PE
of 20
side.
is at the top of how high it should ever be.
Right. It's been over there only a few times ever over 20, and that's when usually inflation's about 0. In the early 60s, when inflation was about 0, we got a little bit over 20. Now we have a very low inflation rate. So if you usually have subtracted inflation from 20, you've had the PE of the market. That's been a pretty good ratio. When inflation was 12%, you remember in the early 80s, we had an 8 or 9 PE in the market.
So Dr. Lynch says all of this has been good for us?
Well, I'm telling you, it would not have been helpful.
It's like a purgative or something.
I never thought I'd ever wish for the market to not go up dramatically. But let's argue the market went to 16,000.